Hi and welcome to our channel. In today's video, we'll be diving into an exciting topic. Why should you invest in gold and silver mutual funds? We are going to cover everything you need to know, including definition of gold and silver funds, advantages and disadvantages, categories, returns, mutual funds and physical metals, mutual funds versus ETFs, top mutual funds, and taxation. Let's begin. But first, a quick introduction to PA Wealth. We are an investment services group offering stocks, PMS, mutual funds, alternative investment funds, insurance, and startup investments. We upload research videos on different companies, mutual funds, and financial topics every week. Subscribe to our channel and hit the bell icon to stay updated on the latest market trends and potential multi-bagger stocks. Let's start with our gold and silver mutual funds. These investment vehicles concentrate on gold and silver related products such as bullion, coins, mining stocks, and their exchange-traded funds. They are growing more popular in India due to their tax advantages, high liquidity, and low transaction costs. Most of these funds are structured as funds of funds, meaning they invest in other gold and silver related funds or exchange-traded funds. Their performance closely follows the market prices of these commodities, making them attractive to investors seeking exposure to precious metals. Now, let's look how it works. Gold and silver mutual funds pool money from multiple investors to invest in assets related to these precious metals. A professional fund manager manages these investments, making decisions based on market trends and asset performance. These mutual funds provide liquidity, allowing investors to buy or sell units at current market values with lower transaction fees than owning real gold and silver. By investing in these funds, individuals can diversify their portfolios, buffer against inflation, and potentially profit from price appreciation in both metals. Now, let's look at the advantages and disadvantages of investing in mutual funds. First, advantages. 1. Diversification. Gold and silver mutual funds help reduce overall risk by diversifying holdings. 2. Professional management. Qualified fund managers make decisions based on market conditions, potentially leading to higher returns. 3. Liquidity. Mutual funds offer easy buying and selling compared to physical metals, which often involve higher costs and processing delays. Second, disadvantages. 1. Market volatility. The value of these funds can fluctuate significantly, reflecting changes in gold and silver prices. 2. Expense ratios. Management costs can diminish returns, so it's important to compare various funds before investing. 3. Lack of control. You give up control over specific investment decisions to the fund manager, which may not suit hands-on investors. Now, let's explore the categories of mutual funds. Funds of funds. These invest in other exchange-traded funds or mutual funds, adding an extra layer of management costs but diversifying across various gold or silver-related assets. Actively managed funds. Fund managers monitor gold and silver prices, buying and selling futures contracts, or mining company stocks to outperform the market. Now, let's look at the gold and silver returns over the last 5 years. Metal price fluctuations, caused by inflation, currency strength, and worldwide market movements, have a direct influence on the success of these mutual funds. Investors see these metals as safe haven investments during times of economic uncertainty, making mutual funds based on them a popular alternative for individuals looking for protection. Now, look at mutual funds versus physical metals. Investing in these assets may be done in a variety of ways, with gold and silver funds and physical being common options. Each alternative has its own set of benefits and cons, catering to different investor preferences. Understanding the distinctions between gold exchange-traded funds and real gold and silver is critical in determining which choice best corresponds with an investor's financial objectives. Now, let's look at the differences between gold mutual funds and gold exchange-traded funds. 1. Investment method. Gold and silver ETFs are traded on stock exchanges, requiring a demat account, whereas mutual funds can be bought directly without one. 2. Transaction costs. Exchange-traded funds usually have lower costs, but mutual funds may charge an exit load if redeemed during a lock-in period. 3. Liquidity. Exchange-traded funds offer higher liquidity as they can be traded anytime during market hours. Mutual funds are redeemed at their net asset value, calculated at the end of the trading day. Now, let's look at the list of gold and silver mutual funds in India. Here's a list of some popular gold and silver mutual funds available in India. Now, let's take a look at the taxation of gold and silver mutual funds. First, capital gains taxation. Old rule: gold mutual fund units purchased before March 31, 2023, and sold after 3 years will be subject to long-term capital gains tax at a rate of 20%, along with the benefit of indexation. If investors purchase gold mutual fund units after April 1, 2023, they will add the gains to their taxable income and pay tax according to the applicable income tax slab rates. New rule: There is no special tax rate for investing in gold mutual funds during this interim period. If investors buy units between April 1, 2023 and March 31, 2025, they must include any gains in their taxable income and pay tax at their respective slab rates, regardless of the holding period. Investors who buy gold mutual fund units after March 31, 2025 and sell them after 2 years would pay a 12.5% tax on the profits, without the advantage of indexation. That's all for today. If you found this video insightful, give it a thumbs up and subscribe for more research-based financial content. Don't forget to click the bell icon for alerts on potential multi-bagger stocks. Got a topic you want us to cover? Drop it in the comments below. Thanks for watching, and we'll see you in the next video.